Hi everyone, it's Matt and welcome to part 6 of our FX trading course. In this video, we're going to take a look at lessons from history in the FX markets. Before we do that, let's have a quick recap on what we've learned so far in this 7-part FX course. In part 1, we looked at an introduction to FX trading. Then in part 2, we went through all of the components of an FX trade. In part 3, I showed you a live FX trade being taken. And in that example, you could watch the trade getting taken and then the profit and loss movements in the account, the margin that's taken out of the account, and everything all coming together in that small video. So that's a really important one to watch if you haven't watched that already. In part 4, we spoke about account management and position sizing. Then in part 5, we looked at analysis in the FX markets. And in that video, I showed you the 3-step process that I use for trading FX markets. The first step, obviously, is to follow the trend of the market. And as I discussed in the video, I do that on multiple time frames. There's no one magic time frame, daily chart or a weekly chart or a monthly chart, that's going to be the key to all of your trading success. You've got to be aware of the trend on multiple time frames and see how it all fits together. The second step is then to find the turning points, which gives you the end of the trend. One of the problems that trend traders have is that they miss the start and the end of a move because it takes time for the trend to declare itself. Well, if you can find the turning points in the move, if you can focus on techniques that are going to help you call the tops and the bottoms of those swings, that's a massive advantage in trading. And it actually will help you to get into trades earlier with a much higher reward to risk ratio and also a higher probability of success. And if you've seen the video on our YouTube channel called Trading the Easy Way, you'll know that's exactly what I'm talking about here. Getting in early, very close to the turn with a very small risk is going to give you a high reward to risk ratio on your trade. And once you're taking trades with a high reward to risk ratio, your success ratio isn't as important and you're not going to be worried if you have a loss here and there in the market. They're going to be a lot easier to take because you know that when you're right, you're making 10 to 1 or more on your risk. Once you've found the turning points, that gives you an entry into the market or potential entry, and that's when it's time to fill in your trading plan. And that's the third step in the process. So that's what we discussed in part 5 of this series. That's the approach that I follow when I trade FX markets. And if you'd like to learn that specific approach, you can learn that from the Active Trader Program online training. Just click on the link in the description to this video and open up the demo right now, and you can have a look at that program for yourself. There's no credit card required. All you have to do is click on the link and you can start watching those videos immediately. Now, still to come in the series, we have part 6, which is this video, where we're going to look at lessons from history in the Forex markets. And then in part 7, we're going to wrap things up by actually setting up for an FX trade. We'll bring everything together from these previous 6 lessons and we'll set up for an actual FX trade. In our previous videos in this series, we've spoken about a gentleman called W.D. Gann. Gann was a famous trader and forecaster from the 1900s. In fact, the work of Safety in the Market and David Bowden is based on the work of W.D. Gann. And Gann said that history repeats. And that's a phrase that gets thrown around a lot. Whenever people see a pattern repeating or something going on, they'll say, oh yeah, history repeats. But Gann actually meant it. He said history literally repeats because human nature doesn't change very much. He went on to quote the book of Ecclesiastes in the Bible, where it says, what has been will be again, what has been done will be done again, and there is nothing new under the sun. And that quote is so relevant for financial markets and particularly the foreign exchange markets. Now, that doesn't mean that we'll never be surprised in the market because everything's happened before, but you'll be amazed at how often the same things happen again and again. And you'll also be amazed at how surprised people are, even though they've probably lived through the same thing happening many, many times over. So in this video, I'm going to take you through 7 lessons from history that I've learned by going back over the past and looking at previous case studies and living through some of them. I'm going to list them all now and run through them briefly, and then I'm going to take a deeper look at them as the video progresses. So the first lesson is the idea of the flavor of the month. When it comes down to it, there are only 2 things that are going to move a currency up or down, and they are supply and demand. If there's a lot of supply of a currency but not much demand because no one wants to buy it, the price is probably going to go down. And if there's a lot of demand for the currency and not enough supply, that's going to push the price up. However, for people to come to those decisions, where they decide they want to buy or they decide they want to sell a currency, there's all sorts of things that they are going to consider. Some people, like myself, will look at the technicals. Others will look at the fundamental side of things, particularly news announcements and economic data that comes out. Now, it's very hard to stay on top of every single piece of information that is relevant to your currency. So what tends to happen is that the market as a whole, and perhaps this is pushed by the financial news media, but the market as a whole, they'll tend to focus on one particular item, one particular news item, and that becomes the flavor of the month. So rather than trying to focus on 10 or 20 or 30 different economic indicators, just pay attention to what seems to be moving the market. Have a look every time your currency makes a big move, have a look at the news that is associated with that. I'm not convinced that the market is moving because of the news, because often the market will seem to move in the direction of the trend and the news will be interpreted that way. But that's a discussion for another day. Just pay attention to the news item that was associated to that move, because you'll normally find there'll be a flavor of the month, and it's more like the flavor of 3 months or flavor of 6 months. And news will come out that could be very positive or negative on one of the other indicators, but it won't attract that much attention. Whereas news will come out on the flavor of the month, and even if it's not that big of a move, the market almost seems to overreact in favor of that technique that's the flavor of the month. And I'll give you an example of that a little bit later. The second lesson that I learned is that the trend of the market is more important than the news. So that's always very important. When you're looking at the news, have a look at how the market interprets the news according to the trend of the market. And I'll show you an example of that on the US dollar yen. Lesson number 3, nobody can control the FX price. And I know that's hard for some people to understand, but I can tell you from years and years of experience, we see it over and over again in the market. People think that they can control the price of their currency, perhaps the government or the central bank, but in reality, nobody controls the price of the FX market. They're just too big. They're multi-trillion-dollar markets. $6 trillion go through the FX markets every single day. So nobody has the power to control that price, or I should say, nobody has the power to control that price for very long. The fourth lesson that we're going to look at is that carry trades are not risk-free. A carry trade is when you're holding a position and you're getting paid interest just for holding the position, and it can seem like free money. But I'm going to show you with an example that they are not risk-free and they can be very dangerous. Lesson number 5, don't believe everything you hear. And obviously that applies to life outside of trading as well. But I want to show you that sometimes the prevailing logic that's out there isn't actually accurate when it comes to markets. So I'll show you an example of that. Lesson 6, interest rates can change rapidly. Now, as I record this in March of 2022, Australian interest rates are at all-time lows, and people think or they know that they're going to go up a little bit at some point in time, but people aren't all that worried about interest rates. Well, hopefully when you look at this lesson from history, I might be able to change your mind about that a little bit. Interest rates can change a lot more quickly than we think. So we'll look at that example. And then lesson number 7, it is possible to forecast, and I'll talk more about that when we get there. So let's start with this concept of the flavor of the month. During this 2-year period on the Euro-US dollar currency pair that you can see on screen in front of you, both the Eurozone and the US were going through major debt problems. And the markets were quite rightly concerned about both of the currencies. There were concerns about the Eurozone with all the debt, and there were also concerns that the US had far too much debt as well. Now, during that time, have a look at how markets reacted. In July of 2008, we had this top in the euro, and the euro just shot down until October. It really tanked. Then we shot up into a December high. Then we ran down into a March low. Then we ran up into a November high. Then we ran down into a June low. While these moves were going on, I noticed during the down run, the media focus was all about the Eurozone and the problems that they were experiencing. Then, during this run up here, it's like there was a switch in focus and the flavor of the month changed, and people weren't so much interested in the Eurozone. That was old news. It's like it had already been done. We'd heard about it too many times. Now everyone wanted to talk about the US debt. So in this case, the euro shot up because everyone was worried about the US. Then it flipped again to the downside and people realized, oh, hang on a minute, that Eurozone debt, that's really bad. Then it flipped again and we went up, and etc., etc. Whichever way you look at it though, whether you're looking at it from the Euro side or the US side, the flavor of the month for these 2 years was debt. And that was the key thing that we were hearing about in the financial news media. So if you're a trader and you're looking at the news during this time, obviously anything that's coming out about the debt, if you can look at your Forex Factory calendar, which we spoke about in the last video, and you see an announcement coming out about debt levels, well, obviously that's one that you're going to want to pay attention to. Now, the flavor of the month will change, and you will have to adjust to that. But this is a good technique to shortcut your fundamental analysis a little bit just by paying attention to what the market is looking at the moment. The second lesson that I want to talk about is that trend is the most important thing. It is more important than the news. And the example that I'm going to share with you is the August 2008 period on the US dollar Japanese yen. I had called this top, this 15th of August 2008 top. I thought that would be the top for the year. We'd been running up since March, but we hit this top level in August, and I thought that's the top. And I went short a couple of days after that top as the market was going down. Now, the market went down for 4 days, and I thought, great, I'm right on this trade. But then the next day, we had this huge up bar here on the market. The market shot up, and I'm going to zoom in so you can see that in a little bit more detail. It opened low, and it closed right at the top of the bar, and it was accompanied by massively positive sentiment in the market. Think of the most bullish news story that you can, the most positive piece of news that you can, and sentiment was just really bullish on this market. And I was absolutely convinced that I was wrong on my trade. I thought, look how strong this market is. No one's going to be able to fight that. This thing's going up. I'm going to get taken out of my trade. Now, that's quite common in trading. You will find that your emotions come into play and you'll feel some fear when the market's going against you. You'll feel greed when the market's going in your favor, and you have to learn to deal with those if you want to be a professional trader. But in this case, even though I had stop losses on up the top here, I was just convinced I was going to be taken out. And in fact, I almost closed my position thinking that, well, I may as well limit my loss because this thing's going higher. Look how positive everything is. But then I sat down and I did my analysis and I looked at my swing charts. And this was the position of the swing chart at the time. And I saw that after our August top, we had run down. See this blue line that I've overlaid on top? That's the swing chart. We had made a lower swing bottom over here. And what we were currently doing was running up. And at this time, even though it was so strong, we were still just running up into a lower top potentially on the swing chart. And I thought, well, okay, maybe I'm wrong on this trade and maybe it is going to take me out. But I got into this trade for good reasons, dependable reasons, and I trust the analysis and I trust those reasons. If I get taken out, so be it, but I'm going to give this trade room to breathe and I'm going to give it the best opportunity that I can. And what ended up happening was the market formed a lower top and then continued to the downside. In fact, this phenomena here is what's known as a retest in the market. See, I have an expression, nobody rings a bell to declare that the top of the market is in. What you normally see is the top comes in, the market falls away a little bit, and then we have this concept called a retest where people see the market at 110, then it falls to 108, and they think it's cheap. They don't know that the top is in unless they know price forecasting. So what happens is people will come in to buy and the market looks strong, but in reality, it's just running up into a lower top. And actually, W.D. Gann said that that first lower top is often the safest place to buy because that's where you can see for sure that all of the bullish momentum has been exhausted. There's no more buyers. It's a lower top. And then people can start to recognize, oh, it's a lower top. It's going to start to head down now. And that can actually be the safest place to sell. So in this case, I decided that I would follow the trend of the market rather than the news of the market. And I'm really glad that I did because as you can see, there's the top. The market actually ran up on the Monday as well. So it still went a little bit higher. But then for the rest of August, the rest of September, October, the market ran down quite strongly. And that ended up being a really good trade. But had I paid attention to the news over the trend of the market, I could have exited the trade up here for a break even or a small loss and missed out on that whole move down there. So it's always important. Pay attention to the trend of the market. And safety in the market students with the active trader program, you might like to go and investigate that 15th of August 2008 top and put your price forecasting techniques over that and see if you could have called that top. The next lesson I want to take you through is this idea that nobody can control the FX price. In 2022, I think more so than any time in history, there is so much talk of conspiracy theories and people controlling things. And depending on who you talk to, they'll say it's this group or that group who's controlling things. Well, when it comes to the FX markets, of course, people will say that the government can control it, or the central bank can control it, or the big traders can control it, or the algorithmic traders control it. But in my experience, I've seen that nobody can control the FX price, or at least nobody can control that price for more than a very short period of time. It is possible, of course, for a central bank to come out and say something and the market will agree with them and it will push the price in the direction that the central bank wanted. But it doesn't take long for supply and demand to balance itself out again. And if the market is going down, nothing is going to stop that market from going down. No government, no central bank, not even algorithmic traders. Now, I remember traveling to Switzerland in 2010 and thinking, wow, what a beautiful country. But compared to Australia and compared to the rest of Europe, it was very, very expensive. And at the time, the Swiss National Bank decided that life in Switzerland was getting too expensive and they didn't want that to happen. And they thought that one way they could deal with that was by pegging the price of the Swiss franc against the euro. Now, as you can see down here, running into this August low in 2011, which is what spurred on the Swiss National Bank to make this decision, the euro was getting very, very weak, which means at that time, now this chart is the euro against the Swiss franc, so it's 1 euro to 1 Swiss franc. So if the euro is getting weak, it means the Swiss franc is very strong against the euro. Now, there are positives and negatives to a strong currency. But generally speaking, a very strong currency is a drain on the economy. It's great for travelers going overseas or buying things from overseas, but it's not so good for importers because it makes everything else more expensive and that drives up the cost of goods in the country as well. So on this day here, the 6th of September 2011, the Swiss National Bank decided that they wanted the euro-Swiss franc exchange rate to be at 120 or higher. And they came out and said that. So as you can see, the euro Swiss franc was trading at about $1.10 or 1.10 euros at this point here. And it shot up 1,000 points in the day on that announcement, up to this 120 level. And the Swiss National Bank said, we are going to defend that price of 120, whatever it takes. And the way that they defended that is obviously by going in there and buying euros. Now, when this happened, the term that was used was that they were pegging the price of the Swiss franc to the euro. In other words, joining it to the euro so that there wouldn't be these wild fluctuations and they could have some normality there. Now, straight away at that point, I knew that it was pretty much game over for trading this currency pair and probably for trading the Swiss franc too. In fact, I told safety in the market students I wouldn't even be looking at the Swiss franc from then on until that peg was moved. Now, when you think about it, you can't physically peg a free-floating market. It's like saying, well, the price of ANZ shares are currently $30. We're not going to let them go below $20. Well, if people want to sell their shares and they want to accept less than $30 for them, they're going to do that. You can't stop a free-floating market, and it's the same with a currency here. So they weren't actually pegging it, but what they were going to do is they were going to buy euros and make sure that they defended this $1.20 line. So the end result is the market just basically flatlined for about 4 years and it just hovered around that $1.20. There wasn't a lot of speculative trading going on in this market during that time, and it got very, very boring and flat. Until, of course, the inevitable happened and the Swiss National Bank decided that it was becoming too expensive to maintain this peg. They had spent, I believe, over 400 billion euros buying euros and holding those euros just to defend this price level. And at some point, you run out of money to keep buying and buying and buying in the market. And on the 15th of January 2015, they announced to the market that they were no longer going to defend that level. And have a look what happened. The euro absolutely collapsed against the Swiss franc. It fell about 3,500 points almost instantly because what happened is you would have had traders with stop orders to sell below this 120. No one's going to be buying below 120 because no one expects it to go down there. So you've got people selling and no buyers. So the price just collapses. And a lot of those orders would have been filled at these low prices, and then the market shot back up after that as well. Now, as this market collapsed, there were stories of traders who had $5,000 trading accounts now owing their brokers $10,000, $20,000, $30,000. It was crazy. They were heavily leveraged and the market collapsed. However, it's really a market that you should never have been trading. The minute a central bank comes in and declares they're going to defend a line like this, two things are going to generally happen. Firstly, a lot of speculators are going to leave. So it's going to be a pretty flat market for the most part, and there's not going to be a lot of movement in there, unless, of course, the currency significantly strengthens and it looks like it's going to move to the upside. So it's going to flatline. It's going to be messy and choppy at the very least. The second thing that's going to happen, though, is that at some point, they're going to remove that peg because it just becomes too expensive. It might be 6 months. It might be 6 years. It might be 10 or 12 years. But at some point, they're going to remove that, and this happens. Now, a lot of traders got hurt by that, but it's a currency that they just could have avoided. There are 5 other major pairs out there. There's any number of cross pairs that they could have traded. Why would you trade a market like this that's A, flat, and B, is going to explode at some point? It doesn't make sense to me. But what we can learn from this is that nobody can control the FX price. Even the Swiss National Bank, who had a very large war chest at their disposal for the purposes of defending that price level or controlling that price level, and they couldn't do it. So just keep that in mind next time you hear someone say they're going to control the currency price. My suggestion is that A, they won't be able to, and B, find something else to trade until that all blows over. The next lesson is that carry trades are not risk-free. So this is the chart of the Australian dollar against the Japanese yen in 2008. This trades to 2 decimal places, and here we ran from 88 up to 104.48. So it looks like a pretty good market to trade. While that move was happening, though, we actually had a carry trade at the same time. So let's quickly revisit what a carry trade is. A carry trade is where you are paid interest simply for holding or carrying a currency pair. And these occur when the interest rate of the currency that you buy or go long of is higher than the interest rate of the currency that you sell or go short. So if you're buying the Aussie dollar against the Japanese yen, you're going long the Australian dollar. So you receive interest at the Aussie dollar interest rate and you pay interest at the Japanese yen interest rate. And the net effect is you're really paying or receiving currency one minus interest rate of currency number two. So in this case, let's have a look at the interest rates. In 2008, the Australian dollar interest rates were up around the 7% mark. At that same time, the Japanese interest rates were at about 0.5% over here. So you've got to be careful. You've got to look at the scale over here because it looks like, oh, they're pretty high as well. But of course, they're pretty high when they're coming up from 0 and the scale only goes to 0.6. So that's a 0.5% interest rate. So if you think about it, 7% interest on the Australian dollar, you'd be receiving that if you were long this currency pair, and you would be only paying interest at 0.5% in the Japanese interest rate. So your net effect is about a 6 to 6.5% gain in interest. So from 2007 to 2008, during that period, Australian interest rates were consistently 6 to 7% higher than Japanese interest rates. So that means that a $100,000 long position in the Aussie dollar Japanese yen would receive interest at around 6%. So that equates to $6,000 per annum or $16.43 every day. Now keep in mind that at the time, you could take a $100,000 position for only $500 margin. So if you think about it, you're putting up $500 margin on the trade and you're getting $16 interest deposited into your account every single day. That's a pretty good deal. So you can see why people piled into the carry trades. Now, I want to stress that carry trades can be a good deal, but they are not risk-free. Let's have a look what happened later in 2008. The Australian dollar against the Japanese yen fell from 104.48 down to 55.08. That's almost 5,000 points. It's basically halved in value. I can promise you, any money that you made in interest on this run up here would be absolutely dwarfed by the money that you lose in a fall like this. Okay, and I'm going to give you an example of how to calculate that. If we look at this FX table over here, we can see at the bottom the Aussie dollar Japanese yen for a 10,000 Aussie dollar position. The tick size is 0.01, and the tick value, every 0.01 or every 1 point, is worth 100 yen. Now, keep in mind, we're looking at a $100,000 position, so we'd be looking at 1,000 yen for every tick movement. So a position of $100,000 would have a tick value of 1,000 yen per 0.01 movement. During this time, the Aussie dollar against the Japanese yen fell almost 5,000 points to 55.08. 5,000 points times 1,000 yen means that during that time, if you had bought at the top for your 6% interest, if you'd bought at the top there, you would have lost 5 million yen on the way down. Let's convert that to Aussie dollars, and we'll do that at the rate of 55 yen. Remember, your profit or loss is converted when you exit the trade. So let's say that you held in all that time and the market fell to 55, you'd be converting at 55 yen. Now, 5 million yen divided by 55 would mean that a 5 million yen loss equates to $91,000 Australian lost. Okay, that's 90% of the account. Now, remember, a $100,000 position, you only need $500 to open that position. So, I mean, if you've got a $100,000 account, your broker will let you ride that loss all the way down. Now, that $90,000 loss, that's a little bit more than the $6,000 interest. And remember, you only get $6,000 interest if you hold it for a whole year. Okay, and some people would do that. They would say, well, over the course of the year, I think this is going to go up, so I'm happy to trade it without a stop loss, and I'll bank my $6,000 interest. And yay, there's a great return on my $500 margin. But again, as I said, if you lose on the currency exchange, you're going to lose a lot more than the interest. So the lesson here is never trade a currency just for the interest. Always, always, always use a stop loss order. The last 3 lessons that I want to take you through all relate to this 1992 British pound top. And for those who haven't watched all of the previous videos, this was the top, which was called Black Wednesday in England. And this is the top where a trader by the name of George Soros made $1 billion in a single day's trading as the pound collapsed in September of 1992. And there's the bar there. The pound fell by 10% on that one day, and Soros was able to lock in $1 billion. I had heard about this trade from pretty early on in my trading days. It was a bit of a legend. It was the biggest currency trade or biggest profit or loss that had been taken at the time, and it was very famous. Everyone knew about the Soros trade, or the George Soros trade, or Black Wednesday in the UK. And George Soros became known as the man who broke the Bank of England, even though there were lots of other speculators who were short at the same time as well. I guess he was the only one who was interviewed and whose story became known. But there were all sorts of people shorting the British pound at the time. It wasn't just George Soros. Now, I'd known about this George Soros trade for a long time. It was fairly common knowledge in the FX trading community. But it wasn't until I bought a book from the airport while I was waiting for a delayed plane. It was a biography of George Soros, and it detailed everything in the lead up to this trade and the aftermath of the trade. And at that point, I decided to do a lot more research into this top. I challenged myself. I said, using your existing techniques, the price forecasting techniques that you use, could you have called that top before it happened and been able to trade it? So I went back and I studied this top, and I actually found that the techniques in the active trader program not only called this top, but called it clearly, and they called it well in advance as well. And there is actually a lesson inside the active trader program online training that details this top, and it actually starts about 7 years ago. And from there, we start building up the case for this top in the market. And by the time you get to the end of the case study, you'll be convinced, as I am, that that was a very, very tradable top. Now, George Soros never really came out and said how he called that top. All he said was he believed that the Bank of England would be forced to withdraw from the exchange rate mechanism, which we're going to talk about in a moment. And he believed that that would trigger a collapse in the pound. So he was looking at fundamental reasons. Was he also looking at technical reasons? I don't know, and we'll probably never know because he hasn't said. But all I can tell you is this: using price forecasting techniques, you could have called that top. So let's talk now about the 3 lessons I want to share with you from this 1992 British pound top. A little bit of background: you just heard me talk about the exchange rate mechanism. The exchange rate mechanism was an agreement that was designed to keep European currencies within certain boundaries. And countries had to sign up to this agreement. And what they were agreeing to was that they would have trading bands for their currencies. So they'd have a high and a low price. And if the market rose above the high price, then the country would be responsible for selling the currency and pushing it down below that high price back into the trading band. And if the price fell below the trading band, then the country would be forced to strengthen that currency and push it up to keep it within that band. So the responsibility for controlling the currency was placed on the countries. Now, obviously, we know now that no one can control the currency price. So we've seen that from previous examples, and this was discovered as well at the time when England were unable to protect the value of the pound. But this whole exchange rate mechanism, it had another consequence, and that was that it severely limited governments and central banks when it came to dealing with things like interest rates and inflation. It's very hard to push your currency up if at the same time you want to decrease interest rates and help the economy out. So there's all these little conundrums that come up. And in the end, it just became very difficult for England to stay in the exchange rate mechanism. And George Soros said that he foresaw that England would have to leave the ERM. And that's why he took his short trade. So England faced all of these challenges in 1992. And there was a lot of talk and a lot of debate as to whether or not England should stay in the ERM. Now, the Prime Minister of the day, he was adamant that they stay in there. And this is where don't believe everything you hear comes in. This is the first lesson. Before the crash actually happened, it built up over a period of time because traders were building up their short positions. They were convinced that the pound would fall below its threshold and that England wouldn't be able to bring it back above and that they would have to leave the ERM. George Soros was one of those traders, of course. But everything's building up. But the Prime Minister of the time, John Major, and the Chancellor of the Exchequer, Norman Lamont, they were adamant it wouldn't happen. And in the months leading up to the crash, they were vehemently denying that England would ever leave the ERM. They were saying, no, we fought hard to get here. We're not giving up these gains. We're not changing anything. We're going to stay here and we're going to tough it out, basically. So they were adamant that it wouldn't happen. And to their credit, they weren't just talking. They did everything that they could to defend the pound. They took numerous measures. They raised interest rates, they intervened in the currency, they borrowed money to buy pounds and strengthen up the currency. They backed up their words with action. I don't think they wanted to leave the ERM. They were adamant that it wouldn't happen. Now, in the end, England left the ERM anyway. They didn't have a choice. The market just crashed too much. They had exhausted all of their ammunition to keep the pound strong, and they had been defeated, and England had to leave the ERM. So despite what they said and how adamant that they were that it wouldn't happen, it happened anyway. Now, I want to make a really important point here. I'm not saying that they were lying. I'm certainly not saying they were lying or that they were incompetent or anything like that. But in financial markets, this is what many people don't understand, even people high up in government or in important positions. There are things in markets that you cannot control. Market forces are so strong that sometimes we can't stand in their way, no matter how much we think we can. So when I say don't believe everything you hear, I'm not saying go and be suspicious of every comment that everyone ever makes. I'm just saying take it with a grain of salt. As an example, over the last year and a half, the Reserve Bank in Australia have been saying that interest rates won't rise until at least 2024. At least 2024. Could be later. Okay? Now, I was skeptical of that at the time, and I'm still skeptical here in March 2022, because we've just seen the US raise interest rates because their inflation levels are getting quite high. And there's already expectations among the banks here in Australia that we're going to see interest rate rises as early as June 2022. Now, it's fine for the Reserve Bank of Australia to say that interest rates won't rise until 2024. They may want that, they may believe that. But if market forces come into play, and if we see inflation start to kick in, they really have no choice but to raise interest rates. You know, conditions change in the markets. when they make those announcements or when they make those declarations that England won't leave the ERM or interest rates won't rise here in Australia, I'm sure that they're doing the best that they can and they actually believe that that's the case. But as I said, conditions change. So don't assume that just because it's been said by someone in a high position, whether that's the Treasurer of Australia or the Governor of the Reserve Bank of Australia, be flexible and be open to the fact that it might happen. Now, speaking of the Australian dollar and interest rates, this next lesson is very, very important for everyone here in Australia and probably in the US as well. Interest rates can change rapidly. There's a narrative going around Australia at the moment that the government or the RBA won't allow interest rates to rise too quickly because it will crash the property market or it will kill the economy and all these sorts of things. And they say, oh, interest rates, if they do go up, they'll just go up a little bit at a time. Well, I want to show you an example of just how rapidly interest rates can rise. And again, this goes back to the 1992 British pound crash. On the 15th of September 1992, that's the day before the crash, the interest rate in England was 10%. It's a lot higher than interest rates at the moment all around the world, but it was 10%. On the morning of the 16th of September, interest rates were raised by 2% to 12%. Think about that for a moment, a 2% rise in one day. In Australia, the majority of our interest rate movements, up or down, have been by 0.25% at a time. There are some outliers that are a little bit bigger or a tiny bit smaller, but generally speaking, 0.25% is the standard amount that an interest rate will be raised, and that will be it for the month. This was a single day, and interest rates were raised by 2%, or the equivalent of 8 interest rate rises at once. And if that's not bad enough, in the afternoon of that same day, rates were raised by a further 3% up to 15%. So now you've got an interest rate that's gone up by 5% in a single day. If you've got a variable mortgage and your interest rate just went up by 5% in a single day, have a think about what effect that's going to have on your repayments. That's massive. It's going to be terrible for the economy. It's going to be terrible for people. It's going to be terrible for businesses. And obviously that's all going to reflect on the government as well. So obviously it's not something that anyone wants. But sometimes these things have to happen because of fear of a worse evil. So for example, interest rates in this case were being raised in order to protect the value of the pound because the Prime Minister and the Chancellor of the Exchequer believed that if the pound fell and England were forced to leave the exchange rate mechanism, they thought it would be a terrible blow to obviously to the value of the pound, but also to the British economy. And they didn't want that. So in order to protect everyone from a worse evil, they were imposing this to defend the pound. And that's what may happen with our interest rates here in Australia. People say, oh, the government can't allow interest rates to go up too much too quickly, or they won't allow it to go up too much too quickly. But they may not have much of a choice. If inflation starts to kick off, inflation is far worse to the economy and to everyone's wealth and livelihood than some higher interest rates are going to be. So if they feel that inflation is a danger, they won't hesitate to raise rates quickly and consecutively. In fact, there are predictions in the US that we may see 6 interest rate rises by the end of the year. So bang, 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 6 interest rate rises in a row. So remember these 2 lessons here. Number 1, don't believe everything you hear. Just because they say it won't happen doesn't mean that it can't. And number 2, interest rates can change rapidly. So protect yourself from that if you can. Now, in spite of all of that, in spite of those 5% increases, and actually in spite of everything they did, all the pounds that they bought, etc., the pound still collapsed. So again, think back to our previous lesson. No one can control the FX price. Some of our high-level students at Safety in the Market, I've walked through all of my research on that British pound top, and you can just see that it was at the right part of the cycle that the pound was due to fall. It basically had to go down, and it did. It didn't just fall, it collapsed. So these are all important things to keep in mind. When I started trading in the early 2000s, I was told by many people that it is impossible to accurately forecast markets by any method. The 1992 British pound top is an example of a very successful forecast. In fact, David Bowden, the founder of Safety in the Market, he was well known for his amazing forecasts. So before we go on, what is a forecast? Well, a forecast could be just simply entering a trade here in the belief that it's going to go down. That's a forecast. A forecast can be done on the day of the trade. It can be done 2 days after you're in the trade. You might say, oh, I'm in this trade, but I think it's going to go further than I thought. I forecast it's going to crash now. And that's a forecast. A forecast is any prediction of what the market action may do in the future. Now, obviously, as traders, we hear these stories about David Bowden. He called the 1989 top a year in advance on the SPY 200 here in Australia, and he nominated the correct price, correct to the point as well. So we hear these really cool stories. Personally, as a trader, I think if you can forecast the correct top on the day or a day before, even the day after the top is usually enough for you to make a lot of money from the trade. Ideally, if you can forecast it on the day of the top or the day before, you're going to be able to enter a very high reward to risk ratio trade in the market. Now, this trade was back in the 1990s, and I'll admit things were a lot different back then, okay? Surely today people will say with computers and algorithms, quantitative analysis and all these things, surely it wouldn't still work. These forecasting techniques, surely they've all been worked out. Well, let's look at some recent calls. This was my trading from January of this year. I called this top of 73.14, the 13th of January top. I called that on the day that it happened. I was a little bit uncertain as the market was running up here. As it all clicked together, I called that before it happened and was able to trade out of there. Now, that's not the sort of thing that you brag about. Yeah, I recognized the top hours before it happened, but at the end of the day, it ended up being a very good trade. Similarly, this 72.76 top, I called to within a couple of points about a day or so before that actually happened. And finally, the exit price down here, I actually recognized a few days before it happened. So that's an example of current forecasts today. Now, think about this. With computers, with algorithmic trading, all quantitative analysis, all these sorts of things that are out there, people say, oh, you can't forecast markets, markets are rigged, and all these sorts of things. Well, if that was the case, I shouldn't be able to call these techniques now, but I did. Now, those are my most recent forecasts. If we just go back a couple of months, though, this November top on the Nasdaq last year, that was called using the exact same techniques that called the Australian dollar tops this year, and the exact same techniques that called the top of the British pound in 1992. Now, I didn't trade the 1992 top on the British pound because I was only about 11 years old at the time that it happened, and I was still in school, and I didn't even know what FX markets were. But the techniques have stood the test of time. This top on the Nasdaq we called in our coaching programs, and we called about 3 months before it happened. This top on the S&P 500, again, was called a couple of months before it happened. We called that top to within 0.5% of the price and expected a big fall from there. That was the COVID crash of March 2020. So the lesson that we can take away, the third lesson from the British pound top, is that it is possible to forecast. The big turns in financial markets are remarkably similar in how they come together. Whether that's the British pound top that we've seen, whether that's the Nasdaq, the S&P 500, crude oil, stocks, any market, the big turns are very, very similar in how they come together. And when I say big turns, I'm talking about weekly swings in the market. So you get a couple of those, 2 to 3 of those a month. The monthly swings, the yearly tops and bottoms, all these big turns that you really want to trade and the turns that are going to give you those high reward to risk ratio trades. They're remarkably similar in how they come together. And really, once you know what to look for, you can go and set up numbers to watch on any liquid market that's out there. I mean, if you find a stock and maybe $100 goes through it every day, it's not a liquid market. No one's going to buy and sell it. You're not going to see these patterns. It's going to be very hard to put a top or a bottom forecast together. Okay. But on a liquid market, it's fairly straightforward to do, and it's the same process each time. And I will talk about this in another video on our YouTube channel at some point where we look at how price forecasting actually works. But the key to price forecasting is having the right techniques and the right numbers or the right fine tuning of those techniques, and then applying those techniques in the right sequence. And that's what you need to do to put these forecasts together. And of course, all of that is taught in the Active Trader program. But when we're talking about setting up numbers to watch on any liquid market, well, FX markets are the most liquid markets that are out there. Now, if you want to learn more, click on the link in the description and check out the Active Trader Program online training. As I said, it doesn't cost you anything to look. Have a look and see the process that's outlined in there and see if you think that's right for you. So let's recap our 7 lessons from history. Lesson 1, the flavor of the month. What do you think is the flavor of the month that's driving markets at the moment? What's dominating the news headlines? Lesson 2, the trend is more important than the news. What is the trend of the market that you're following at the moment? Lesson 3, nobody can control the FX price. Lesson 4, carry trades are not risk-free. There's not a lot of carry trades available at the moment. The Turkish lira has very high interest rates. The Russian ruble has very high interest rates as well. Neither of those are necessarily currencies that are stable or markets that I would encourage you to trade anyway. But just remember, when you take a carry trade, to always place a stop loss order. Lesson 5, don't believe everything you hear. And again, it's not about conspiracies or hiding the truth. It's simply that the people in power, the prime ministers, the treasurers, the governors of central banks, they're not traders, and a lot of them haven't really studied markets from a trading perspective, or more importantly, they probably haven't traded their own money in financial markets to understand how these lessons actually work. So if you think that something sounds too good to be true or a little bit off, just be open to the fact that maybe it is, and ask yourself, well, if XYZ scenario happened, how would I react? How would markets react? Lesson 6, interest rates can change rapidly. They can move a lot faster than people think, and they don't have to necessarily go up in 0.25% increments. They can move very, very quickly if the need arises. And finally, lesson 7, it is possible to forecast. The George Soros trade, that was the first forecast that I had ever heard of. And it always stuck with me because of the fact that he made $1 billion from one day's worth of trading on the British pound. But it is possible. And until I learnt how to do this for myself, I was always in two minds. Part of me really wanted to believe that forecasting was possible because I was working in a bookstore. I wanted to get out of there. I had debt. I had low income. I wasn't going anywhere. I wanted to be able to forecast. Oh, this could really help me. I want this to be true. But there's the other side of my mind that thought, it's a scam. It doesn't work. No one can forecast prices. That's impossible. All these kind of things. But believe me, it is possible to forecast. As I said, I'm on record for calling those turns in the market. And if you'd like to see how that 1992 British pound example came together, it's all there waiting for you in the Active Trader program. Now, that's all for part 6 of this series. I hope you enjoyed it. Still to come is part 7, where we're going to look at setting up for an FX trade. So when you're ready, I will see you in that final video. Thank you for watching. If you are new to the channel, please make sure that you click on the subscribe button. If you enjoyed the video and found some value out of it, please click on the like button and keep an eye out for part 7, setting up an FX trade, which is coming soon. Thanks for watching. All the best with your trading, and bye for now.